Walk into any bank and they'll try to sell you a mutual fund with a 1.5% fee, a fancy name, and a track record of underperforming the market. Walk into any financial advisor's office and they'll put you in a dozen different funds to make it look complicated. But here's the truth they don't want you to know. A child with 3 index funds can beat 90% of professional fund managers over 20 years. And you can build that portfolio in 15 minutes for less than the cost of a pizza. If you stay until the end of this video, I'm going to give you the exact 3-fund portfolio, tickers, percentages, and brokers that has outperformed 90% of active funds for decades. No stock picking, no market timing, no stress. Just simple, boring, beautiful math that will make you wealthy. My name is your name, and today we're going to simplify investing forever. Let me start with a story that will make you angry. In 2015, a friend of mine named Derek went to a financial advisor recommended by his bank. The advisor put him in 15 different mutual funds. Some were large cap, some small cap, some international, some emerging markets, some real estate, some commodities. Derek thought he was being smart, diversified, professional. He paid an annual fee of 1.8% for the advisor plus the fund expense ratios averaging 1.2%. Total cost 3% per year. Over 10 years, that 3% fee would eat nearly 30% of his returns. After 5 years, Derek's portfolio had grown only 18%, while the S&P 500 had grown 45%. He was furious, fired the advisor, moved everything to Vanguard, and put it all in a single S&P 500 index fund. 3 years later, he had caught up and surpassed his old portfolio. He told me, "I paid thousands of dollars for someone to lose my money. Never again." Derek's story is not unique. The SPIVA report, which tracks active fund performance, shows that over 15-year periods, more than 90% of large-cap active fund managers fail to beat the S&P 500. That's not a typo. 90%. You have a better chance of guessing a coin flip correctly than picking a fund manager who will beat the index over the long term. And the ones who do beat it 1 year almost never beat it the next year. It's luck, not skill. So what's the solution? The 3-fund portfolio. It was popularized by investing legend Taylor Larimore on the Bogleheads Forum based on John Bogle's philosophy of low-cost index investing. The idea is simple. You buy the entire haystack instead of searching for needles. You own every stock and bond in the world in a simple ratio that matches your risk tolerance. And you do it for microscopic fees. That's it. Here are the 3 funds. Write these down. Screenshot this. Fund 1, Total U.S. Stock Market Index, asterisk. This owns every publicly traded company in the United States, from Apple and Microsoft down to tiny local banks and regional retailers. In one fund, you get diversification across all sizes, sectors, and styles. Vitality, D-Tote, iShares BlackRock. Expense ratio, 0.3%, do 3%. That's 3R to $1.50 per year on a $10,000 investment, basically free. Asterisk, Fund 2, Total International Stock Market Index. This owns every publicly traded company outside the U.S., developed markets like Japan, UK, Germany, and emerging markets like China, India, Brazil. International diversification protects you if the U.S. market has a lost decade, which has happened before, most recently 2000 to 2010. It also gives you exposure to company and Tencent, tickers, VXUS, Vanguard, FTI, HX, Fidelity FTUS iShares, expense ratio 0.07% to 0.08%. Still incredibly cheap. 3. Total U.S. Bond Market Index. This owns thousands of government, corporate, and mortgage-backed bonds. It provides stability and income. When stocks crash, bonds often go up or hold steady. This reduces the volatility of your portfolio and gives you ammunition to rebalance, selling bonds to buy stocks when they're cheap. Tickers, BND, Vanguard, FXNAX. iShares expense ratio, 0.03% to 0.025%. That's it, 3 funds. You don't need anything else. No sector funds, no REITs, no commodities, no crypto. The total stock market already owns real estate investment trusts and commodity-related companies. The international fund gives you emerging markets. The bond fund gives you safety. This portfolio captures the entire global market of investable assets at the lowest possible cost. Now, what about asset allocation? How much in each fund? That depends on your age, risk tolerance, and goals. Aggressive rate, age 20 to 40, high risk tolerance, 70% US stocks, 20% international stocks, 10% bonds. Example, 70% VTI, 20% VXUS, 10% BND. This portfolio targets 9–10% long-term returns with moderate volatility. In a bad crash, it might drop 35–40%, but it will recover. Moderate, age 40–55, medium risk, asterisk 50% US stocks, 20% international stocks, 30% bonds. Example, 50% VI, 20% VXUS, 30% BND. Expected return around 7–8% with lower volatility. A crash might see a 20–25% drop. Asterisk conservative, age 55 plus, near retirement. 30% US stocks, 10% international stocks, 60% bonds. Example, 30% VTI, 10% VXUS, 60% BND. Expected return around 5–6% with much lower volatility. A crash might see a 10–15% drop, which recovers quickly. You can adjust these percentages to your personal comfort. The key is to pick an allocation and stick with it for decades. Don't chase performance. Don't change because international did well last year or bonds are paying more. Rebalance once a year, sell what's done well, and buy what's lagged to keep your percentages in line. That forces you to buy low and sell high automatically. Now, let me show you why this portfolio beats 90% of active fund managers. It comes down to 3 factors: cost, diversification, and tax efficiency. Cost. Asterisk. The average active mutual fund charges 1.2% per year. The average advisor charges another 1% for management. That's 2.2% total. The 3-fund portfolio costs about 0.05% total. Over 30 years, a 2.2% fee drag reduces a $100,000 portfolio to about $400,000. The same portfolio with 0.05% fees grows to over $1,000. That's a $600,000 difference for doing nothing different except avoiding fees. The math is unforgiving. Low cost wins every time. Diversification. Active managers pick 50 to 100 stocks. They're betting that their picks will beat the market. But as we saw, 90% of them fail. The 3-fund portfolio owns thousands of stocks. You're guaranteed to get the market return. And since the market goes up over time, you're guaranteed to make money. Not might, will. Guaranteed is a strong word, but over 20-year rolling periods, the US stock market has never lost money. Never. International has had flat decades, but combined with US, the global portfolio has always been positive over 20 years. That's as close to guaranteed as investing gets. Tax efficiency. Asterisk index funds have very low turnover. They buy and sell stocks only when the index changes, which is rare. Active funds trade constantly, generating capital gains distributions that you have to pay taxes on even if you don't sell. In a taxable account, the 3-fund portfolio is a tax stream. And if you put it in a Roth IRA or 401(n), you pay 0 taxes forever. Active funds can't match that. Now, I can hear the objections. But what about Warren Buffett? He beats the market. Yes, he does. He's one of the greatest investors of all time. But he tells ordinary investors to buy index funds. In his will, he instructed that 90% of his wife's inheritance go into a low-cost S&P 500 index fund and 10% into bonds. Not Berkshire Hathaway stock, index funds. If the Oracle of Omaha says index funds are the best for regular people, who are you to argue? But what about the lost decade of 2010? The S&P 500 was flat. That's true. But the three-fund portfolio with international and bonds did better. And more importantly, if you were investing monthly during that decade, you bought cheap shares. A person who invested $1,000 a month from 2000 to 2010 ended up with over $200,000 by 2020. The crash was a gift. The three-fund portfolio turned that gift into wealth. But I want to beat the market, not just match it. I get the desire. Everyone wants to be a hero. But the evidence is overwhelming that almost no one can consistently beat the market after fees. The few who do, like Renaissance Technologies, don't sell their secrets to retail investors. They use supercomputers and PhDs. You have a spreadsheet and a dream. Don't gamble. Own the market. You'll end up richer than 90% of people who try to outsmart it. Let me give you a real-world comparison. We'll use three investors: Active Alice, Stock Picker Steve, and Three Fund Theo. Each starts with $50,000 at age 30, adds $500 a month, and retires at 60. Active Alice uses a high-fee mutual fund recommended by her bank. 1.5% expense ratio. Average annual return before fees 9%. After fees 7.5%. After 30 years she has about $680,000. Stock Picker Steve picks individual stocks. He has a 70% success rate on his picks, which is excellent. But his losers sometimes drop 50%. His average annual return is 8%, better than many, but he spends hours each week researching. After taxes, he trades often, so short-term gains, his after-tax return is about 6.5%. After 30 years, he has about $580,000, and he's stressed the whole time. Three Fund Theo uses VTI, VXUS, BND with a 60-20-20 allocation. His expense ratio is 0.05%. He earns the market return of 9% before fees, 8.95% after fees. He uses a Roth IRA, so no taxing. He spends 15 minutes a year rebalancing. After 30 years, he has about $950,000. He beats Active Alice by $270,000 and Stock Picker Steve by $370,000. And he slept like a baby through every crash because he knows his portfolio will recover. That's the power of the three-fund portfolio. It's not sexy. It doesn't make for good cocktail party conversation. But it works, and it works for everyone, from the barista making $30,000 to the doctor making $300,000. Now, let me address the specific brokers. Vanguard is the original home of index funds. Their ETFs and mutual funds are excellent. Fidelity is also great. They now have zero expense ratio funds like FZRX, Total US, and FZLX, Total International. But those funds are proprietary and can't be transferred to another broker, so I prefer VTI and VXUS for portability. BlackRock's iShares ETFs are also excellent and trade commission-free at most brokers. You can't go wrong with any of them. The key is to pick low-cost index funds, not the brand. What about target date retirement funds? Those are also excellent for people who want a one-fund solution. A target date fund like VFFX, Vanguard Target Retirement 2050, holds a three-fund portfolio internally and automatically rebalances and becomes more conservative as you age. The expense ratio is slightly higher, about 0.08%, but still very low. If you want true set it and forget it, buy a target date fund. But I prefer the three-fund because you have more control and slightly lower costs. Both beat active management. Now, let me give you a step-by-step guide to building your three-fund portfolio today, not tomorrow. Today, step 1. Open a brokerage account if you don't have one. Choose Vanguard, Fidelity, Schwab, or any major broker. All offer commission-free ETF trading. Do this online in 10 minutes. Step 2. Decide your asset allocation using the age-based rules above. If you're unsure, start with 60% US stocks, 20% international stocks, 20% bonds. That's a solid middle ground for most people under 50. Step 3, fund your account. Transfer money from your bank. If you have an IRA or 401(n), consider using that for tax efficiency. But even a taxable account is fine for this portfolio because index funds are tax efficient. Step 4, buy the ETFs. For a $10,000 portfolio, you would buy $6,000 of VTI, $2,000 of VS, and $2,000 of BND. Use market orders, don't try to time the price, just buy. Step 5, set up automatic investments. Most brokers allow you to buy fractional shares of ETFs now. Set an automatic monthly purchase of your target dollar amounts. For example, if you're investing $500 a month, buy $300 VTI, $100 VX, $100 BND each month. Automate it and forget it. Step 6, once a year, log in and rebalance. Check your percentages. If VTI has grown to 70% of your portfolio and BND has dropped to 10%, sell some VTI and buy BND to get back to 60-20-20. This takes 15 minutes. Do it on your birthday each year as a gift to your future self. Step 7. Do not watch financial news. Do not read stock tips. Do not change your allocation because everyone says bonds are dead or international is a lost cause. Stay the course. The 3-fund portfolio is a marathon, not a sprint. The people who win are the ones who don't quit. Let me tell you about a real person who used this strategy. A viewer named Ellen was a single mom, 35 years old, making $55,000 as a nurse. She had no investing experience. She was scared of the stock market. I told her about the 3-fund portfolio. She opened a Roth IRA with Vanguard, put 70% in VTI, 20% in VXS, 10% in BND. She contributed $200 a month, what she could afford. 8 years later, at age 43, her portfolio had grown to $38,000. That's not millions, but it was a down payment on a house. She told me, "I can't believe how easy it was. I spent more time choosing my Netflix show than managing my investments." And it worked. That's the beauty of the 3-fund portfolio. It works for everyone, from the nurse to the neurosurgeon. Now, here's a controversial take. Some people say, you don't need bonds anymore because interest rates are low. Or you don't need international because US has outperformed for a decade. Those people are performance chasing. They're making the same mistake as active managers. Bonds provide stability. In 2022, both stocks and bonds fell. That was rare. But over the long term, bonds reduce volatility and give you dry powder to buy stocks during crashes. International provides diversification. The US won't be on top forever. In the 1970s, international outperformed US. In the 1980s, US outperformed. In the 2000s, international outperformed. You don't know what the next decade will bring, so own both. That's the whole point of the 3-fund portfolio. You admit you don't know, and you own everything. Another controversy. You can just use an S&P 500 fund and skip international and bonds. That's a 2-fund portfolio. It's still excellent, but it's less diversified. The S&P 500 is only large-cap US stocks. You miss small and mid-caps. You miss international, you miss bonds. Over long periods, small caps have outperformed large caps. International has sometimes outperformed. Bonds have saved portfolios in crashes. The 3-fund portfolio is the most complete, most boring, most effective solution for 99% of investors. Now, what about the specific tickers for non-US viewers? This script is for USA, UK, Canada, Australia. In the UK, use Vanguard's FTSE Global All-Cap Index Fund or similar. In Canada, use VCN ex-Canada World, and ZAG bonds. In Australia, use VAS, Australian stocks, VGS Global, and VAF bonds. The principle is the same, low cost. Broadly diversified index funds. Your local Vanguard or iShares will have equivalents. Search for total market ETF in your country. Let me give you the single most important piece of advice about the three-fund portfolio. The only way you can lose money is if you sell when the market is down. That's it. If you never sell and you keep buying through crashes, you will make money. The market has always recovered, and it always will, because the global economy grows over time. People innovate, companies produce, populations increase. That trend is unstoppable. The three-fund portfolio captures that trend at the lowest possible cost. It's not a bet, it's a certainty. So here's your actionable plan for the next hour. 1. Open a brokerage account at Vanguard, Fidelity, or Schwab. Choose Roth IRA if you qualify. Do it now. 2. Decide your asset allocation based on your age. Write it down. Point 3. Fund the account with whatever you have, $100, $500, $1,000. Don't wait until you have more. 4. Buy the ETFs, VTI, VXUS, BND in your chosen percentages. If you have less than $1,000, buy fractional shares or use mutual funds. Most brokers allow fractional ETF shares now. Point 5. Set up automatic monthly investments. Even $50 a month is enough to start. 6. Put a recurring calendar reminder for 1 year from today to rebalance, and another reminder to never watch CNBC. Point 7. Comment below. I'm a three-fund investor starting today. Make the commitment. Then share this video with a friend who's still paying 1.5% fees to a professional. Hit like if you're ready to stop overcomplicating investing. Subscribe and turn on notifications. In the next video, I'm going to show you how to churn credit cards for free flights and cash back, even if you have average credit. You won't want to miss it. The financial industry makes billions by making investing seem hard. It's not hard, it's three funds. That's it. Now go build your portfolio and get on with your life. I'll see you in the next video.